He is the founder of
Good
Emo.
evening.
Whoa, JC on the first ring. How you doing this morning, JC?
I'm doing well. How are you guys?
We're doing good. We're doing good. Well, let's get your take here. You were decidedly bearish the last couple of weeks when we talked to you. Is there a point of interest here? We just talked about all these stocks that were making new 52-week lows, and are basically taking out the flash crash lows. But the SPOOs, I know you don't. We'll just talk SPOOs. This is a reference point. We're still 90 points above that flash crash low. Is it only a matter of time before we get down there?
Yeah, I think we probably head down there and probably break it. Like I've been saying, I'm not trying to buy stocks. I'm not looking for, opportunities, at lower prices to buy stocks. I just, the last few weeks, really since last month, I've been looking for opportunities to sell stocks, looking to sell rips. I haven't really been
Yep.
interested at all in buying dips. And, I've been pretty vocal about that. We got a nice little rally into last Thursday's little powwow and rolled over nicely. So we're happy to see that.
Did you catch anything? I know you were hoping for Apple to get to 120. It didn't get there. You had four highs at the 116 area. That thing's been a little bit stubborn here. Maybe that Goldman Sachs upgrade. I mean, we had that nice rip. Really, the only super fake out rip was after the Fed announcement. You had that breach of 2000, which if you would have been using a 5 minute chart, you never would have bid on it because I don't even think we were over 2000 more than 5 minutes. Was there anything you were able to get on that?
Well, we've been in mostly cash, but if you look at things like healthcare, for example, healthcare was a good one. Rallied back up to that former overhead supply, then rolled over. You got things like consumer staples, for example, rallied back into that overhead supply. And when we talk about overhead supply, we're talking about all of the former support from throughout the year that broke down. And, to your point, you're talking about Apple, how Apple never got back up to that overhead supply. I think that's a bad thing. I think the fact that it wasn't even able to do that, I would have to take that as a negative. So just overall looking at the market, forget staples or healthcare or Apple or anything like that. You can go back and see and look at the names that bounced back to that former overhead supply that we were looking for and then rolled over. And I think that the ones that didn't and weren't even able to do that just shows you how much weaker they are. That's how I look at those names. So, yeah, I'm still bearish. Obviously, we haven't seen anything in the market to suggest changing that thesis. To the contrary, the market has done exactly what we wanted to do, so we couldn't be more thrilled.
JC, what about these stocks that not only didn't bounce back to resistance, but didn't even really bounce at all, and now are making new 52-week lows? We just went through about 7 or 8 of them, looking at like Caterpillar and Joy Global. We looked at some retailers and Kohl's and Macy's. We looked at Wynn Resorts, UTX. All these stocks are taking out their flash crash lows and are making new lows. First, let's go to Caterpillar because it's a lot of people talking about it this morning. It got initiated with a sell rating at Axiom, and they put a $28 price target on this thing. What are your thoughts here on the cat?
Yeah, getting back to the point of the stocks that bounced and weren't able to hit back to overhead supply, the stocks that are already rolling over making new lows, those are the worst of the worst. Caterpillar, obviously, put in that category, but that's nothing new. Caterpillar has been one of the worst stocks in the out of the Dow 30 for a long, long time. You could group that in with the energies of the world, the Chevrons and the Exxons. Maybe not as bad, but certainly towards that category. You go back in Caterpillar and look at all of that support near $80 that goes back to the 2012 lows. That broke down in July. So there's been no reason to own this. You have a downward sloping 200-day moving average. This has been a sell any and all strength whenever possible sort of stock. And it certainly looks like we're going to continue to head lower. This shouldn't be surprising at all. We're probably heading under 60. That's the 61.8% Fibonacci retracement of the entire 2009-2011 rally, about $58. It's probably where we're headed next.
What about FANG, talking Facebook, Amazon, Netflix, and Google. And some of these stocks have bounced back nicely here. Like, I mean, Facebook, if you take that, for instance, got up 52-week high is 99.24, trading at $93 here right now. It's really within striking distance of its all-time high. Are you looking at stuff like this as there's still overhead supply in something like this? Or is this a stock that could actually buck the trend and actually make new all-time highs here in the near future?
Again, like I said, I'm not trying to buy stocks.
Okay.
I'm not trying to get.
You're just hands
cute.
off.
I'm not trying to get cute, and I'm not trying to get cute and buy the handful of names that aren't crashing. I mean, that just, that doesn't make much sense to me. That's the equivalent. Buying stocks up here that aren't crashing is the equivalent of, buying, trying to short, some of the stocks that, aren't going up, so one of the few stocks that aren't going up during a bull market. You're fighting the overall trend, looking for the few good ones, like when we were in a bull market and everything was going great, instead of it's the equivalent of, instead of trying to buy the leaders, you're trying to short the weakest ones during a raging bull market. Here, we're trying to fade strength. We're not trying to buy stocks. So why am I going to focus on a few of the good ones? I mean, yeah, they're good. Those aren't the ones we want to be shorting, but that doesn't necessarily mean we want to be buying it and fighting the overall market trend. I think that's silly. Plus, a lot of these names, I mean, great. Yeah, I agree 100%. They definitely are the strongest ones. But, not Google or Netflix, but if you look at Amazon and Facebook, momentum, we look at a 14-day relative strength index. Momentum hit oversold conditions in both Amazon and Facebook on the last decline, and that's not good. I'm not telling you the stocks are going to crash. I'd rather be short something like Caterpillar or, some of the emerging market garbage out there. But, when you have stocks in bull trends and they hit oversold conditions on corrections, that's not an indication of a solid uptrend. So that would actually concern me. I would look at of your clever FANG, that you mentioned earlier. Netflix and Google, I would say, are probably the stronger ones because they didn't hit oversold conditions on the recent decline. Doesn't necessarily mean that they won't on the next decline. I'd actually argue that they probably will.
We're on the line with JC Parets. He's the founder of Eagle Bay Capital, a certified market technician. JC, a lot of times when you have a decline in the market, money goes to commodities, and you're not really seeing that here. First, let's just touch on the crude market here. Massive consolidation here, just about the 50% retracement of that rally here. Just running into a wall here at 47 and a change. Goldman Sachs calls for $20 oil a few weeks back here. What are you making out of this consolidation in the crude market?
Well, I don't necessarily agree that when, the stock market sells off, money goes into commodities. I haven't, looking back at history, I haven't seen that at all. Are you referencing a specific time period where that actually happened?
Well, I mean, during the 1980s when you had, the gold, maybe just more specifically to gold as a flight to quality.
In the 1980s, the stock market was going up all through the 80s.
Okay.
I think Joel's just saying there is this overall perception in the markets that gold is a safe haven. When the market starts to go down, money will fly into gold. That obviously has not worked here lately. He's just saying is that overall.
So you're not buying commodities, you're not buying stocks, and you're not shorting stocks, JP. What should people do with their money?
Right. Well, I'm a big fan of cash, and I'm a big fan of fading strength and actually shorting opportunities where we get rallies. I don't make recommendations. I don't tell anybody what to do. I'm telling you what we're doing over here. We're looking to fade strength and be heavy cash. As far as gold being a safe haven, I don't know who made that up, but that's clearly not true. The safe haven is Japanese yen. I say it again and again and again. You look at the negative correlation between U.S. equities and gold, it's not there. You look at a negative correlation between U.S. equities and treasuries, sometimes it's there, sometimes it's not. But you want to look at the most reliable negative correlation with the S&P 500 and yen. That's the bottom line. That is, without a shadow of a doubt, where money is going to when it's scared. It's coming out of stocks. You know where it's going to go? It's going to go into yen. Maybe it'll go into gold. Doubt it. Maybe it'll go into treasuries, probably, but it's definitely going into yen. So that's what we want to look at. Getting back to your question on crude oil, the thing's a mess. We rallied back up to the former overhead supply that we were pointing out to. That was support in January and March, where we originally wanted to get long, if you guys remember, at the end of March, going into the second quarter, and that worked out well. That former support that broke became overhead supply over the last month or so. So that shouldn't be surprising at all. As far as whether oil is going to go to 20 or not, that I can't tell you. But when you have that much overhead supply in oil and a downward sloping 200-day moving average sitting right around 54, this has staged any strength written all over it. Very similar to U.S. equities. And getting back to your question, what do I recommend people do? I don't make recommendations for people, but what do I think is the best trade right now? I continue to like yen. There's no doubt about it. I hate stocks. I think they go lower, and the negative correlation with yen and U.S. equities is through the roof. And I think yen breaks out.
So you're bullish yen. If you're jumping into specific stocks, because you talked about fading or selling the rips there, which stocks have you been looking at selling here the last couple of days here? Because we did have a couple spikes. It's been kind of a yo-yo market here, at least for the last week and a half. Is there any couple stocks that are setting up nice that you think, might be a good short opportunity?
Look at financials.
Okay.
Financials, we view that as one of the most important sectors out there in the market. You want to talk about overhead supply. I mean, this is tough, man. I just cannot. I find it very, very difficult for the market for financials to get going here with all of that overhead supply. I mean, we literally ran into the 61.8% Fibonacci retracement of the entire 2007 crash. I mean, we kissed it and rolled over. I mean, you can't make this stuff up. The market respects these levels. I know a lot of people that choose to ignore them purposely. I have no idea why. The market continues to respect these levels. We want to look at financials. Look at regional banks, KRE. We rallied right back up to that former overhead supply that was support in July and in August. We literally ran right up there, kissed it, and rolled over. I mean, you can't draw that up any nicer. Regional banks, I think, continue to roll over. XLF financials, I think they continue to roll over. Look at the broker dealers. Look at IAI. All of that overhead supply from all of 2015. We weren't even able to get up there. So I think of that group, I think regional banks are probably the strongest because they were able to get up to that overhead supply. The fact that broker dealers didn't even get close, I think that's a problem. I think broker dealers are probably going to lead to the downside. And then look along this entire time. Look at a name like Citigroup. I mean, you want to talk about garbage. Citigroup is where it was in the summer of 2009. I mean, come on. You weren't able to – we just had one of the greatest bull markets, of some of our lifetimes. I mean, one of the most powerful bull markets in American history, and Citigroup wasn't able to budge from the summer of 2009. I mean, that just screams weakness. So, when you're looking for individual names to short – I'm more of a top-down guy, as you guys know, so we hate financials, and then we work our way down. And you could look at companies like J.P. Morgan and Goldman Sachs that did rally, and look at a name like Citigroup that did not. I mean, you want to talk about relative weakness. This is one of the worst names in the space. Look at a name like Deutsche Bank. I mean, what a disaster DB is. We're making 52-week lows already. We're getting down towards those 2009 lows. I mean, this thing's a mess. So I would just continue to fade any strength. And I'm not looking to buy stocks. I'm looking to short on strength. I mean, that's the trend here until the market proves otherwise. And I think best case scenario, we go sideways and consolidate and build a base. And if that happens, then great. And then we can get long and maybe break out in the first quarter next year. I think that's the lower probability outcome, and I think we probably head lower. Like I've been saying, this is nothing new. I don't think this should be surprising at all.
We've been on the line with J.C. Parets. He's the founder of Eagle Bay Capital. Joins our show every Thursday to discuss the markets. Thanks for coming on, J.C.
Thanks for having me, guys. Go get them. Be careful out there.
Looks like we got to be careful. Thanks, JC.